everybody. Ben Nelson, the Everyday Real Estate Investor here. Thanks for tuning into another episode of the podcast, and I just really appreciate the support and hope that my message is getting out there to everybody. Again, I really, the reason I'm doing this is I really want to speak to those people that are really busy, and again, not just necessarily just this audience, but there's a lot of people that are out there that they've got other things going on, whether it's by choice because they have a professional career, or they have a family, or they have something taking up the majority of their time, or maybe they have a W-2 job that they really don't like, that they're trying to figure out how to transition out of. And there's only so many hours in the day, right? So how do you figure out fitting in real estate investing within that? And so really we want to talk to kind of that audience, and that trying to get people to understand you can be involved in real estate, and you can be getting the benefits of investing in real estate, even if you are busy, or even if it's not full-time, even if that is a goal of yours at some point. So that's kind of the heart behind this. That's what I really want to provide to people, is kind of encouragement and tools and tactics and all that stuff to be able to make it happen. So even if you are full-time real estate investing, hopefully you get a lot out of these podcasts. It's definitely not just for if you're part-time or can't fit it in a full schedule. There's definitely a lot of things in here I think that are applicable to people that are full-time as well. But today we are going to talk a little bit about, I'm going to kind of pull out a few topics and questions of, topics of conversations that have been coming up recently that I've seen. And some of these are recent, and some of these are just over, like they're just very common questions that have people put out there all the time. So I'm going to just pull some of those out. So a lot of these are from different forums, different groups online that I've seen asked. I could certainly pull a lot more than these, but these are just kind of a handful that I have seen a lot lately, or a lot over the course of time. So I'm going to jump right into it. The first question I see a lot is, I have X amount of dollars that I got from whatever, selling my house. I inherited it, however they ended up with the cash. They've got it, and they're not sure what to do with it. What should I do? The whole what should I do question. I have $50,000, I have $100,000, whatever the amount is, what should I do? And they pose it to this huge group of people that really don't know their situation, and they're just asking, what do I do? So my first thing that I would like to say about this question is, I think you're asking the wrong question first, especially if that's all you're putting out there is, I have this amount of money, what should I do with it? Really, what I see in that question is you haven't really thought through what you want it to do for you, what you want real estate investing to do for you. So I always go back to that, and again, that's really just from my mentors. The podcast that I listen to a lot, the most, is the Real Estate Guys radio show. They're great guys. They've got really good advice, and one of their philosophies is your personal investment philosophy. That's where you start, and that's really, I've just really taken hold of that, because I think it's super important, and I didn't do that early on in my investing, and I don't think very many people do. So that's I always kind of gravitate to that, and I just really see that in this question is like, I don't know what to do. So I would really encourage you, if you're asking this question, and when I see this question, I always encourage, go back to the first question, which should be, what do I want real estate investing to do for me? Do I want to be do I want to just try to provide cash flow for myself? Do I want to be an active investor? Do I want to be a passive investor? Do I want to do remodels? What's my ultimate goal, and what do I want my daily investing life to look like? Because that's really going to dictate more what you do with the money, and what is going to be the best strategy, versus just some random person answering the question for you. And if someone answers that question and says this is what you should do with it, and they haven't asked you what your goals are, or what you really want to accomplish, they don't know. They're making up. They're saying what they would do with it, essentially, but that doesn't mean it's what you should be doing with it, because you may not have the same goals. So just be careful if you get advice that is not within the context of what you want real estate investing to do for you. You can get so many answers, and again, it's you can use it as a down payment towards a buy and hold property, a rental, right? You could use it as a down payment towards a flip project. You could use it to buy notes, buy tax liens and tax deeds. You could use it to invest in a syndication, buy shares in a syndication. So there's a lot of things you could do with money if you have it to invest. So again, you really have to go what you can do and what you should do. What you should do is based on what you are wanting to accomplish. So I don't think the question is a bad question. I just think you need to preface it with just really narrow in first on what you want to do and what you want to accomplish so that you can be looking at the right opportunities. Okay, next question. I like this question a lot. So this was on a forum recently, and the question was, why in the world would I hold a property and make $200 or $300 a month cash flow instead of selling it or flipping it and making 50 grand or whatever? I don't remember what the numbers were, but it's a little bit of cash flow per month versus a big chunk of cash, right? Why would you do that? So that's a good question. Why would you? It's really easy to take a look and see. I mean, you're looking at a $300 or $200 a month, and you're comparing that to this big chunk of money, and just say, why in the world would I take $200 over $50,000? That doesn't make any sense. So what you have to do is you have to really open this question up and look at the big picture. The first thing that I want to put out there, though, and I want everyone to realize, is that if you're thinking this way, if you're thinking, why would I take $200 a month versus a big chunk of cash, you're thinking and you're stuck in a self-employment or a business owner or self-employed individual. That's your thought process with that question, is because you're focused on creating revenue, creating cash now, turning a product, inventory and things like that, like builders have, versus an investment. You're not really thinking like an investor if you're thinking, well, I'm going to buy it and I'm going to sell it and I'm going to make money. That's trading. That's a business. That's not investing. And I'm not saying that that's a bad thing. There's a lot you can certainly do that, and you can do that within a portion of your business or to get started. People do that all the time. Wholesaling is kind of another piece of that, right? You're not doing anything, but you're getting something of value under contract and then assigning that to somebody else. But I just don't want to see people stay in that. I think it's a great way to get started, and I think it's a great way to provide capital to actually invest. But I don't want people to get stuck in that and think that this is investing. I'm flipping all these houses every year, and look at, I'm an investor. I would challenge that. I would say you're not an investor. You're in business. You're selling a product, but you're not an investor. And the one of the things that really shows that is look at how it's taxed, right? And so this is part of the unpackaging it and looking at the bigger picture, is that if you buy something and you do something to it or not, and you resell it, that's earned income, and that's taxed differently than if you have cash flow from an investment. And so if you just look at it from the tax perspective and how it's treated from a tax purposes, it's not treated as an investment. It's treated as income. So just from the definition of that, that should show you that it's really not investing. It's creating product, which again is not a bad thing, but you just have to know and look at the whole picture. And again, so earned income is taxed at a very, very high rate, and if all you're doing is making earned income, you're going to have a very, very high tax, lots and lots of taxes to pay, a high tax burden. So you can't just look at $200 a month or whatever that number is, and then compare that to, even on an annual basis, so $2,400 a year, compare that to $50,000. Okay, well, that may be true, and so it's like 5% of the total amount, but you really have to take your after-tax amount, first of all, because you're going to pay a big chunk of that in taxes, and yeah, there's taxes on the cash flow too, but it's very different. And then, once you sell it, it's gone. You don't have that income anymore, right? Whereas with the cash flow, you're going to have that recurring year after year after year after year. So it's slower. You're not going to get the big chunk of cash right away, but over the long term, you're going to make just as much or more on the cash flow. Not only that, you actually have all the other benefits you're going to be paying down if you're assuming you have I mean, if you're only cash flowing at $200 a month, obviously you've got a loan on it. So you're paying down the loan with the rent that's coming in, right? You have, so the amortization of the loan. You've got tax benefits. You can write off some of that earned income. So if you are doing some flips and you're also holding some properties, you can, probably depreciate and offset that earned income, right? Talk to your CPA about that one. But, so you're getting other benefits that are not just weighed in just that cash flow number that you have to take into account. We talked about this on one of the earlier podcasts a few weeks ago, maybe a couple months ago, actually, on the 4 parts of real estate returns, right? So it's not just cash flow, there's other pieces to that puzzle, and you have to factor that in if you're going to do a comparison to know actually what is the better way to go. So I get it. It seems like, and it really typically is a longer game to build cash flow versus just flipping for bigger chunks, but you have to get into the mindset of an investor and building passive income and building cash flow, and not just turning things around and having earned income. So earned income is not what builds wealth. Earned income is fine, but it is not what creates long-term wealth. That's what cash flow and owning assets does. Okay, I'm going to get into a couple more market-related questions, just because there's a lot going on in the market right now. There's interest rates have kind of gone a little, not crazy. Okay, they're actually honestly historically like normal levels now, but they've been so low for so long that and they've gone up so quickly that it's kind of shocking the system a little bit, and people are experiencing, they're not sure what to do, right? And buyers are experiencing the payment that they were going to be making if they bought 4 months ago. Now it's much, much higher. I just saw we're, here in the Portland, Oregon market, and in a lot of other markets, I saw a map that showed how much more it is for a payment than it, now versus 3 or 4 months ago. And in our market, it's over 50% higher for a monthly payment than it was just a few months ago. So it's a huge difference. That's a huge difference. Instead of paying $2,000 a month on something, now you're paying $3,000. That's a large amount. So anyway, this is very market related, and that's the first kind of piece of this. So payments versus price. This was an interesting one that I saw in another group posted that basically was taking your payment, like a house price and a payment when rates were 3%, and then extrapolating that out and saying, okay, here's what that same payment at 6% would get you, and then here's what that same payment at 9% would get you, and it essentially come to the conclusion that if that same payment only gets you this much, then house prices have to fall to this because the payment's the same. Okay. I totally understand the logic in this, but there's so many assumptions in this that I want to make sure that we touch on, because I get it from a logical standpoint. It's like, okay, if I could buy a $400,000 house, I'm just throwing numbers out there, but if I could buy a $400,000 house and my payment was $2,000 a month, and now that same $2,000 a month only gets me $300,000 because of rates, now I'm only going to buy $300,000. Okay, that may be true, but that doesn't mean that same house is now worth $300,000. It does not mean that, because a lot of reasons. It may just mean that you're out of the buying pool for a while because rates are to the point where now the payment doesn't make sense for you. There's nothing out there in that price point that you can qualify for. Typically, what was going to happen, as long as there's a lot of supply, a lot of demand and not enough supply, which is basically where we're at right now. We're way short on housing, right? So people have to live somewhere. Rents are already pushed way up to where that that still doesn't maybe make sense. So it probably could still make sense to buy. And this is obviously market by market that you have to look at that. But what happens a lot of times is, instead of buying, the people that were on the cusp, rates went up, now they can't buy. Okay, now they're on the sidelines for a little while. But the people that could buy maybe a step up, now they're affected in what they can buy, and so they're going to step down to something a little bit lower. Now they're maybe an entry level price point instead of like a step up price point. The other thing is that this is totally assuming that that payment that the average house or whatever they were using that's the most that people were willing to pay, or that the most that people could afford. And I can tell you that that is definitely not true. I'm in the market every day and I talk to people all the time that don't buy the maximum amount that they are approved for. So will they continue to have that? If they continue to have that mindset, obviously that has, you know, an effect maybe on the market or what they can buy. But my point, I guess, with this is that people have made that decision mentally that they're maybe not going to, but with rates going up, they may compromise on that. They may make a little bit of a compromise in that. I only wanted to make a $2,400 a month payment. Well, now it's 28 or whatever it is, and I'm willing to do that now just because that's the situation that we're in. I still want to buy a house. I still see the benefits of it. I could qualify for more than I was before. I didn't want to at the time, but now rates are higher, so now I have to. So that's a big assumption to say, you know, this is what the payment was. Now that's what everybody is going to stick to, is just that payment. That doesn't make any sense. The other thing is that you're assuming that, you know, so wages is a big piece of this. If wages are rising, even with interest rates rising, just like when house prices were rising, then, you know, it has an effect on what people can afford. So if there's incomes are going up in an area, then people can absorb that interest rate increase. And again, and this is kind of a sidebar. That is, again, I always talk about every market is different. You got to look at each market. Some markets might have already been right on the cusp of affordability, right? Where maybe the higher interest rates are going to have a bigger effect, whereas other markets might have growing economies, growing wages, and house prices haven't caught up yet to those new wages that are coming into the area. So there could be still a lot more room for growth, even with higher interest rates. The other thing that I think is just kind of a mindset thing, this also makes the assumption that people aren't willing to pay more for something because it used to be less, whether that's a payment or price, right? So, well, I could have got, again, if the function is just absolute affordability, that's a different story. But if it's just, well, this was my payment and now my payment's going to be higher, so now I'm not going to buy it, that's a totally false assumption, because you're saying that people aren't willing to pay more for something just because it used to cost less money, right? It used to be $2,000 a month. Now it's $2,500 a month. Now I'm not willing to pay for it. We see people that the last 5 years of the housing market, we would have not seen happen if that was true, because every month it was more than the prior month, right? So not forget the year, and people continued to buy. So this doesn't hold water, because people would have been looking back this whole time and said, well, man, that house used to be $300,000, now it's $400,000. I'm not going to buy that. It's the same thing with payment, right? So as long as affordability is there, the payment, yeah, it hurts to pay more than you used to have to pay because interest rates are higher, but it doesn't mean that just all of a sudden people are going to stop buying. So that leads to the next question, which is, given what's going on in the market, should I buy? Should I buy now? I'm going to answer this one real quick. Yes, you absolutely should buy right now, because there are always deals out there. There's always reasons not to buy. I think the crux of this question is trying to time the market, right? Are we at the top? Okay, I totally get it. Like, everybody wants to buy. Everybody wants to buy when rates, or when prices are low. I mean, just the natural thing. You want to get a good deal. You want to pay less. You want to be able to ride the wave up, right? But that's such a short-sighted view of real estate. There are so many benefits to owning real estate, which we touch on all the time. The cash flow, the tax benefits. You're going to still get amortization. When are you going to wait for? Are you going to wait for? Because I can almost guarantee, if you're asking that question, that you're going to start to see house prices trickle down, if they do, and you're going to keep. Okay, I'm just going to wait. I'm just going to keep waiting. I'm going to keep waiting until it's the bottom. Then you're going to miss the bottom, because you don't know it's the bottom until it starts to go back up again. Just like you don't know it's the top until it starts to go down, right? And then you're, oh shoot, I missed the boat. Okay, well, let's see what happens. And you're just going to be waiting. And here we are 10 years later. You haven't bought a piece of real estate because you're so afraid of timing the market. Don't do that. Don't do that. Buy real estate that makes sense, that you are being conservative, that you can manage the cash flow, that's in a good market, and that you can manage the debt, right? And you'll do well. Don't try to timing the market. Trying to do that is a fool's errand. You're never gonna do it. And you want to be prudent. You want to be doing due diligence, and you want to be structuring things right, and you want to be doing all that. But if you're waiting it out, you're gonna miss out. If you're waiting it out, you're gonna miss out. Don't miss out. Okay. Maybe be a little bit more cautious. As we're seeing what's going on, but don't wait and miss opportunity. And remember that terms and deal structure and all of that can play a huge part in whether something makes sense to buy now or anytime, right? So don't just think price or value. Think terms and how to structure that. Creative financing, all that stuff. Be diligent, like I said, in doing your due diligence. Make sure you're setting yourself up for success in case there is a downturn. Be careful with short-term loans, things like that. But don't be afraid to jump in. Don't be afraid, okay? And think long-term, okay? Even if there is a price dip and you bought right now and it went down, 10% or so, it's not going down 40 or 50%, guys. It's not going to happen. But if it pulls back, hey, you bought a $500,000 house, or you bought, $1 million fourplex or something, and it went down 10%. That sucks, right? You just lost $100,000 on $1 million, 10. But you know what? If it cash flows and you're managing the debt, it's going to come back around. You're going to still get the benefits of the cash flow. You're still going to get the tax benefits. There's still reason to own that property, okay? And there's a lot more you can do. There's market fluctuations, but you can manage your property and you can manage that business a lot better than you can manage what the stock market's doing, right? So you got to put your money somewhere. What are we at? Almost 9% year over year inflation. I mean, what are you going to do? Sit on your cash? That's a terrible idea. Don't sit on your cash. Put it to work. Real estate's a great hedge against inflation, which is another case for why prices not dropping, right? Is that typically in inflationary environments, which we're very much in, asset prices continue to go up. So definitely buy now. Buy smart, but buy now. And then this one, obviously, you hear a lot. How do I get started? Okay, I'm just starting out, or I own one rental. How do I keep going? How do I get started? How do I scale a little bit? How do I do more? And these are all going to be a little bit cliche, but I think they're super important because this is how you're successful in real estate. First thing is continue to learn and grow your mindset. Don't stay there. Don't stay and just learn in the learning phase. You have to do things, but learn. Continue to learn. Listen to this podcast. Listen to a lot. There's lots of other podcasts out there. Please don't just listen to mine. Listen to the real estate guys. Listen to some of the guests that I've had on that I have. And actually next week, I'll talk about that in a second. They have podcasts. There's lots of podcasts. There's lots of YouTube channels. Check them out. Learn and grow and expand your mind and get your mindset in the right place. Connect and build relationships. This is a huge one. Don't just sit, listening to this podcast or sit behind your TV, I don't know, your computer screen, and watch YouTube videos and things like that and look at properties. That's great for learning, but you can't just stop there either. This is a relationship business. Deals get done because people know people, and money comes together with a deal, and people collaborate and all that stuff. And you're gonna have a really, really hard time. Yeah, you can buy property that way. I don't believe that that's the best way and that you're gonna get the best deals that way. I absolutely don't believe that. You have to connect. You have to build relationships. Get focused. Okay, there's a lot of ways, just like we talked about in the prior question, I think the first question with what do I do with the money? There's a lot of ways you can get in real estate, a lot of things you can do, but you have to focus in, or you are going to get too spread out. You're going to get you're going to get the shiny object syndrome going, and you're never going to make any ground, get any traction going. You're not going to be able to get anywhere because you're just going to be running on that treadmill and not actually making things happen. So get focused. What is it you want? What are you after? Hone in on that. hone in on your neighborhood, hone in on your criteria, all of those things. What's your strategy? Get that really clear and focused so that you know what things to go after and what things not to. Because especially if you're really busy, you could be looking at deals all day, every day, and probably 80% of them, if you knew what you were looking for, you could toss aside in a minute or less, right? You just look at it, nope, that's not what I'm looking for, right? And you set it aside. Don't waste 30 minutes looking at a deal that's not going to work. But again, if you don't know what you're looking for, you don't know that, and you waste a lot of time. And the last thing is obvious. You got to take action. So all of these things are important. Learning is important. Connecting is important. Being focused, knowing what your strategy is important. But you have to ultimately take action and make something happen. Otherwise, you're just going to be sitting on the sidelines. So next week on the podcast, I am super excited. We're going to be talking about a great strategy, especially for I think for anybody, really. I mean, not just this category. I think there's people that are sophisticated investors that own a lot of real estate that do this too. But I think it's a great way for people to get their foot in the door in investing, for their first investment, and also for people that are very busy and maybe can't manage a project or don't want to do that. And so we're going to be talking about turnkey investing, buying turnkey properties, build to rent, things like that, where you can buy a property that's already ready to go, fixed up or new construction, and you have a team in place to put a tenant in there to manage that property for you, and you get the benefits of the cash flow and all the other benefits of owning real estate. There's a couple different creative ways that this particular company and person has set up for providing opportunities to investors that I think are really cool. So I'm super excited to have Zach Leemaster of Rent to Retirement on the show next week. Don't miss it. It's going to be a great episode, and you're going to learn a lot and hopefully be able to connect with a potential provider that you can connect with to be able to look at some options that might work for your investment strategy. So thanks again for tuning in. Appreciate it. Go out there and make things happen. Don't sit on the sidelines. Go take action and clarify what you're looking for and go find some deals.